Hey, welcome back everyone. This is Uncle Frank, and I am not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Let's start this one off with a shout out to my New York City apes. How you doing? From the Bronx Times. Bronx's multiplex cinema's closure means there's only one commercial theater in the borough left standing. The Bronx's Concourse Plaza, one of the borough's last standing movie theaters, had its final showing this week before closing its doors permanently. According to Multiplex Cinemas, located on 214 East 161st Street, just a few blocks east of Yankee Stadium, the establishment shuttered due to a business decision on May 28th. The closure is significant since Multiplex Cinemas is one out of just a handful of operating movie theaters left in the Bronx, and the second to last commercial theater. Now, the AMC Bay Plaza Theater 13 in the Baychester Co-op City area is the borough's last commercial theater. So, Uncle Frank, why are you celebrating this? Oh, I'll tell you, I fight to win. Don't get it twisted. I hope the industry continues to contract while AMC continues to grow. May AMC be the last man standing on Wall Street, too. I hope we become a legal monopoly in our sector. So if you want to bring content to a live indoor audience, you have no choice but to go through AMC. Yeah, I said it. And it would appear we're not the only ones getting sick of the hedgies. From Bloomberg last week, big investors demand hedge funds beat cash before charging fees. Institutional investors have grown tired of paying fees to hedge funds for what they see as skillless returns. Roughly 24 pensions, endowments, sovereign wealth funds, and others with more than $200 billion in combined hedge fund investments are demanding changes to how the money managers get paid. Investors led by the Teachers Retirement System of Texas are seeking performance fee hurdles, according to an open letter to the hedge fund industry published Thursday. The coalition wants hedge funds to forgo incentive fees until they generate returns that beat 3-month treasuries, which now yield more than 5%. For years, hedge fund fees have frustrated investors, and the biggest and best performing funds often charge clients 2% of assets managed and 20% of profits. In 2019, Element Capital Management famously jacked up its incentive fee to 40%. It has lost money over the past 3 years. That's right, Kenny. They figured out they can replace you by buying treasuries instead of giving you money to buy $100 million paintings during the pandemic. You're not a great trader. Level the playing field and everyone will see what you really are. A bitch-made, punk-ass white boy who has to cheat to win. You've been caught cheating 60 times over the past 15 years, and you still try to pass yourself off as a legitimate market participant. You ain't shit in my book. Okay, this appeared in Barron's on Thursday and is worth mentioning. S&P Global Ratings lowered its issuer credit rating on AMC to selective default from all caps CCC plus following a May 15th debt for equity exchange. The agency says it views the transaction as distressed and tantamount to a default. I've always disagreed with this interpretation. Technically, we didn't pay the debt as agreed, but there is a benefit in swapping stock for debt and pushing out maturities, especially in our case. I've never agreed with the method Adam Aron uses, swapping stock for debt at near all-time lows. I'd prefer building the company's stock price and then selling it, but that's another conversation. S&P said AMC exchanged certain second lien notes due in 2026 for about 23.3 million shares of its Class A common stock. The agency also said it views AMC's capital structure as unsustainable and subject to default risk given its heavy debt burden and negative free operating cash flow. This is why I always push back on raising executive comp plans to levels 2 or even 3 times higher to what our closest competitor pays its executives. I push back on dropping $250 million on green projectors, investing in formerly bankrupt penny stocks, or dumping millions on commercials that appear only in the theater instead of media-wide advertising promoting our company's A-list program, for example. S&P said it plans to review its ratings on the company over the next week, adding it will most likely raise the issuer credit rating back into the CCC category. Now, guys, when this transaction occurred, I emailed John Merriweather asking him to explain who we swapped debt for stock with, and he refused to answer. I suspected it may have been on Tara, and maybe that explains the unusual article from TipRanks, dated May 27th, and titled, "Who Owns AMC Entertainment Stock?" where they're quoted as saying, the ownership structure of AMC stock is a mix of institutional, retail, and individual investors. Approximately 20.94% of the company's stock is owned by institutions. 74.07% is owned by insiders, and 4.99% is owned by public companies and individual investors. On what planet do individual investors of AMC only own 4.99% of this company's stock? What caused an immediate debate in the community is TipRanks, who's never been fair or unbiased towards AMC shareholders, published this item that originated with NASDAQ. The highest number of shares is held by hedge fund Antara Capital, reflecting a 31.8% ownership of the company. The second largest holder is Beijing Wanda, reflecting a 25.6% stake. It seems TipRanks has corrected the error because it now reads Vanguard owns a 7.94% stake in AMC. Next up, Vanguard Index Funds, which holds a 6.26% stake in the company. Until I see different, here's the current reality from Fintel.io. For AMC, 360 institutional owners, 340 long only, 7 short only, and 13 long short. Institutional shares held at 85.4 million or 23.21%. The longs have increased their position by 12.15% MRQ. They report shares outstanding at 368 million. Adam, his entire management team, and the entire board of directors hold less than 0.5% at a pathetic 0.32%. To my knowledge, this entire group hasn't purchased a single share of AMC in 6 years, but did manage to sell over $1 billion worth to you. So who is short AMC these days? Well, according to this self-reported bullshit from Fintel, we've got Susquehanna still leading the pack, Citadel, EMG, and Citigroup. D.E. Shaw just added a new position, and B of A is still holding some puts too. You might be interested to know Goldman, Barclays, Millennium, 0.72, and 683 all closed out their put positions. And here's the long side, guys. A lot of the same names. This is all from May. Vanguard and BlackRock at the top, as expected. And then there's Susquehanna, 7.5 million calls as opposed to 2.3 million puts. Morgan Stanley owns over 5.3 million shares. Citadel, 4.7 million calls versus 1.8 million puts. Everything's changed, guys. The ape did exactly what it was designed to do. It was a rescue mission for Wall Street, a reset button, if you will. Someday, if you own a company, you can explain to me the reasoning behind giving shares of your firm away for a penny as a dividend. Please put your explanation in the comments. Adam sold you on the idea by pretending it would act as a share count, which he knew we desperately wanted. Candidly, I've seen no evidence so-called fake or synthetic shares exist, but many of you disagree. This preferred equity dividend goes only to company-issued shares. so it'll have the impact of a share count or unique dividend many of you have sought. Hashtag today we pounce. So there it is, guys, the short lifespan of our precious little ape. Delisted. Are you satisfied? Did this work out as advertised or as you expected? Is Really Bad Person on Twitter going to do another video about the hidden genius behind this convertible preferred share? We could have offered this out at 10, 15, or even 20 a share, raising millions for the company. I believe our shareholder group has owned this float as much as 4 times over, meaning AMC. Do you really believe we wouldn't have bought this offering up instantly along with institutions? Wall Street needed the ape to go from a like security to a legitimate locate, and Adam served it to them on a silver platter you paid for. Not only did he fuck you with the ape, he named it after you. The real genius of Adam Aron's treachery is some of you still believe he was on your side all along. Hey guys, have you ever read a research paper by mathematicians on the effect of reverse splits? We examined the long-run return performance of over 1,600 firms with reverse stock splits. These stocks record statistically significant negative abnormal returns over the 3-year period following the month of the reverse split. No, you got to be shitting me. Here's a fun fact, guys. Fashion giant Chanel paid Nicole Kidman $12 million to do a short commercial. But Adam paid $25 million so far, more than double for our short in-theater spot. Adam's always a big spender when it comes to your money. Our CEO spends money like there never was a pandemic, like there never was a writer's strike, like we don't have any real debt. He hands out cash and stock bonuses like we're flush with money. Here's our little starlet with Harvey Weinstein back in the day. Heartbreak does feel good when you're down over 90%. All of Adam Aron's images with Harvey Weinstein have been scrubbed from the internet. Go ahead, try and find one. Now, I've mentioned since this trial began that things may leak out that we will find interesting as AMC shareholders. From Bloomberg, Bill Hwang fights to keep Tiger Asia passed from Archegos jury. When Archegos approached the Bank of Montreal about becoming a trading counterparty back in 2020, the Canadian bank at first said no. One big reason was concerns over the prior issues with Tiger Asia. Joe Bacuzzi, a Bank of Montreal risk manager, testified Wednesday at the fraud and market manipulation trial of the Archegos founder. Hey, look, guys, the Bank of Montreal was a put holder against AMC. Anyway, Tiger Asia Management was the hedge fund Hwang ran for more than a decade before founding Archegos in 2013. Its name proudly reflecting his status as one of the Julian Robertson's so-called Tiger Cubs. Yeah, Tiger Global. We remember that incident, don't we? But Hwang's lawyers have been trying to keep the Archegos jury from hearing much about Tiger Asia because the fund pleaded guilty to an insider-related charge in 2012. Hwang settled for $60 million without admitting wrongdoing, but launched Archegos as a family office in part because he agreed not to take outside money. So it's clear you can break all the rules and laws, never admit any guilt, pay a big fine, and then resume putting everyone at risk as long as you use your own money. Got it. The defense has argued that Tiger Asia's legal problems could prejudice jurors as they consider the Archegos charges. The judge recognized that potential on Wednesday when he said prosecutors could introduce a document discussing Bank of Montreal's Tiger Asia concerns, but only with the terms insider trading and market manipulation redacted. Has anyone else noticed that if they would have kicked Bill out of the industry the last time he messed up, Credit Suisse might still be here? And just keeping you in the loop, Glancy, Prangay, and Murray LLP announces its investigation of Apollo Global Management concerning the company and its directors and officers possible violations of state laws. Okay, so T+1 and the CAT live event have come and gone. I still love the potential of what CAT can do. I hope they can mask or encrypt personal information to protect people's sensitive data, but never forget who's at the helm. It's Gary Gensler of Goldman Sachs. When Goldman marks 60 million short orders as longs, they get fined what, $3 million? When Kenny does it, it's $7 million. When Ripple XRP beats him in court, he's looking for $2 billion from them, right? I get it. It's a wildly corrupt system from top to bottom. Way too much power for one man to have, right? Now there's another CAT event coming up on June 5th, industry testing checkpoint call. So I'll add that to the calendar. So we know the CAT's been live for a while, but how's it doing as a deterrent to criminal activity? Let's check the dark pools. Nope. More than half of all orders are still executed away from lit markets. Does that mean half of all orders are institutional block trades? Shit, only 10.52% of GME's orders hit the exchange it's actually listed on. Not a big deterrent as of yet, but we can give it some time. It was actually a typical day for the most manipulated stock in history. In the after-hours session, it got down to 4 flat. Then the action finally came during the last 20 minutes of the trading day. 4, count them, 4 5-minute candles in a row, getting as high as 439, but well below max pain on options expiration Friday to close at 433, up 10 cents or 2.36%. This is perfectly normal trading behavior, am I right? This is real price discovery, not market makers manipulating the stock to make or save millions on premium, all in full view of the regulators and the CAT system, tracking every order and transaction. Followers of this channel know where I stand on AMC. I'm not here to win arguments. I'm here to make winning trades, report the news items that fly under the radar, and to get my money back on AMC, not investment advice or advisor. I will never tell you to buy, sell, or hold any security or cryptocurrency. I've said for a long time now, it will only be a white or black swan event that will deliver us a victory on this trade, something that will impact our enemies adversely. They will have to first lose for us to win. Well, I believe the tweet from Roaring Kitty was a taste of that, a minor white swan that stunned our enemies. Even if it was for only a short time, it was sudden and unexpected. Gil hadn't tweeted for years, but the stock rallied on the excitement of the event after GME. I think it's time to admit we can't take on the most diabolical hedge funds, prime brokers, and market makers in the world if they can cheat, if they can spoof and halt the stock at will with regulators doing nothing. They halted GME and AMC, 38 times in one day? Well, in this episode, we'll research black swans, reviewing this new piece from investor and author Simon Angelo. He runs a trading desk in New Zealand and writes for Wealth Morning. He starts by saying, running money in the markets, particularly rising markets, there is always a sliver of ice in the back of your mind. When will there be another panic event, another crash? Markets are resilient. They can calmly price the trends they see until a black swan event comes along. Black swans were presumed not to exist until explorers discovered them in Australia in 1697. Today, the expression defines high impact but hard to predict inevitabilities. The 2007 global financial crisis was one such event. Liquidity seized up, and the S&P 500 dropped 57%. By the way, 700 hedge funds closed. Anyway, the 2020 COVID-19 crash was another, where it dropped 34%. In both cases, almost no one saw the crash coming. The black swan was unknown until it landed. Could a canny investor have spotted a black feather on the path some months before? Were there early causes that led to these effects? Simon would go on to say, "The other day I was talking to the owner of a security company. His business looks after a large number of supermarkets across Auckland. You can predict when trouble is going to spike, he tells me. He's referring to shrinkage, shoplifting. When there's trouble in the Middle East and the petrol price jumps, makes sense. Petrol goes up, people struggle. Supermarkets see a spike in thefts." Simon's next section is titled Black Swans for This Market. We're in a recovering market. First, there was a global pandemic where prices dropped about 35%. The prices cratered because governments locked down businesses. Investors panicked. How can companies trade when they're locked down? But stocks quickly recovered because governments hosed markets with cash. Then we realized much of that cash had come from cranking the money printing machines. There was an inflationary crisis. To battle that, the screws came on interest rates. Markets are now showing recovery because that battle against inflation is nearing, though has not yet reached a victory. Meanwhile, there's war in Ukraine and the Middle East, though wars don't tend to overturn markets too much unless they specifically disrupt businesses. The next section is titled The War Puzzle. Despite the initial jolt of uncertainty, war has historically fueled markets. Simon quotes Ben Carlson. From the start of World War II in 1939 until it ended in late 45, the Dow was up a total of 50%, more than 7% per year. Was this an isolated trend, a one-off event? Well, no. We have seen the market behave like this in recent times as well. When Russia invaded Ukraine in February of 22, the S&P 500 fell 7% in the weeks following the incursion. But a month later, the market rebounded, and the S&P was trading at a level higher than before the invasion. Some stocks, for example, Rolls-Royce, benefited from defense spending. That company is up over 180% in the past year. Simon's next section is titled Uncertainty and Disruption. Markets are most concerned by these factors. They do not like uncertainty and tend to sell off at the outbreak of any panic event. Investors go to safe haven assets like gold or seek out the most defensive positions. Defensiveness will depend on the nature of the uncertainty. During the global financial crisis, McDonald's held its value. When the pandemic hit, the stock plunged 32%. Investors fretted restaurants would have to close for months. Once the market has digested the uncertainty, it then focuses on the driving force, earnings. How much and for how long will earnings be disrupted? This is what we missed following the outbreak of COVID-19. I underestimated how much governments would subsidize business earnings. While we did pick up many bargains and add large profits, these could have been even greater if we'd predicted government overreaction. The next section is titled The Coming Disruption. Now Simon posts UBS's recently published Global Family Office Report for 2024. It gives a survey of the expected risks and disruptions. Over the next 12 months, the top three: major geopolitical conflict, higher inflation, and real estate correction. But over the next 5 years, again, major geopolitical conflict, followed by climate change and a debt crisis. Then Simon comments, most of these are so anticipated, I reference them for one reason: to suggest to you which risks are probably already priced. While geopolitics is the most difficult area to predict, localized conflict has yet to upset markets over a longer period. A fight over Taiwan could be a different matter, yet the risk has been flagged in Western investment reports since 1979. The real upset to markets over the next 5 years may come from internal division. Now Simon moves to social and political divides. The credit-based economy has seen asset values, stocks and property, rise much faster than wages. In the developed economies where we invest, there appear growing divisions in political outlook. The wedge between left and right seems more extreme. Example, here in New Zealand, many who have missed out on the asset boom now sit alongside a growing left elite in a voting bloc that easily comprises 45%. This saw support for a wealth tax to resolve inequality. The same scenario is seen in some U.S. blue states. What is missed is the effect of a wealth tax on capital markets. John Stowe, finance professor at Ohio University, has written a detailed paper, Wealth Taxes and Capital Markets in 2020. He considers how a wealth tax pushes up the cost of capital, making many projects no longer economically viable. In fact, investment ends up falling every year, meaning there is less wealth to tax in the future. This means less investment, less business, and fewer jobs. You likely end up with many more people falling below the poverty line. As for the impact on the stock market, take a look at Professor Stowe's modeling. Exhibit 2 is titled Value of the S&P 500 Index for Wealth Tax Rates between 0 and 2%. Yes, a 2% wealth tax could see the market fall over 51%. In New Zealand, the Green Party was proposing a wealth tax of 2.5%. Unlike in the United States, the bulk of New Zealanders' wealth is not in stocks but in property. We see no reason why this market will not react similarly to the S&P 500 index in the table. Values crater so deeply, the market would also face a devastating debt crisis. Simon's final section is titled Diversification. It's the one free lunch in finance. One way to avoid the disruption in one market is to be invested in another. While the pandemic was a global event, the risks of political and social division do not fall equally. In Europe and Argentina, for example, the pendulum is swinging resoundingly in the opposite direction. Almost 70% of young Argentines voted last year for Javier Milei's plans to slash government and taxes. Right-wing victories in Europe also follow anecdotal reports of younger voters fed up with high taxes and endless government deductions. In New Zealand, a coalition has been given the chance to right the economy and improve home affordability. They have until 2026 to build confidence and secure their support. Now, guys, be honest, isn't the current administration now doing exactly what Simon warned about that happened in his country? Zero-down mortgages are making a comeback. Many Americans would love to buy a home, but they don't have tens of thousands of dollars to cover a down payment. 0% down mortgages return. What can go wrong? It's a perfect time to do something really stupid, like offering 0% down payments on mortgages. Instead of changing course and fixing the problems, they're coming up with a gimmick. So can we conclude Simon is saying yes, a war in Taiwan could definitely be a swan, but is different from Ukraine or the conflict in Gaza, because war typically brings rallies after the initial shock, but a direct conflict with China would be a very different thing. He infers that many of the potential, obvious, expected swans may even be priced in or quickly will be. But will uncertainty and disruption instead come from the growing political divide in the United States? Guilty on all counts. Trump criminal conviction makes history. And then from the New York Times, Biden campaign aims to exploit Trump's guilty verdict. Could the political unrest in the United States we're seeing intensify, with Trump's conviction being a black feather we should pay closer attention to? Simon points to a wealth tax as being a swan we're not watching for or prepared for. Biden attacks billionaires, floats raising corporate tax during State of the Union. Under Biden tax plan, capital gains tax will exceed 50% in 11 states. Biden floats net investment income tax hike in new budget. Biden's billionaire tax takes aim at the super rich. But can a wealth tax work in reality? It seems as though this theme is already a primary driver of Biden's strategy. To be honest, I'm already seeing some of Simon's comments and theories playing out in my own trading. On your screen is the weekly chart for the VIX. I added a trend line going back to 2022. One way to avoid the disruption in one market is to be invested in another. I haven't paid close attention to the VIX in a long while, but as you can see on this daily chart, that new 52-week low of 1152 caught my eye. That new low occurred on May 23rd, just Thursday of last week. My subscribers know I make event calendars all the time. The week ahead had 9 different Fed members speaking publicly, the advent of T+1 and the CAT system live day. Not to mention we had PCE coming up on Friday. This all with the backdrop of a war in Ukraine, a war in Gaza, and China aggressively circling Taiwan. Because I was feeling the uncertainty Simon was talking about, I felt it was time to be long volatility. The VIX was just way too low for all the drama that was scheduled for the coming week. So on Tuesday, when the market reopened after the holiday, I went long the June 1350 calls, expiring June 5th, for 46 cents. On the 30-minute chart, you can see the VIX vaulted to a high of 1487 last week and began to cool rapidly by Friday as PCE came in as expected, but the move allowed me to exit the calls at 95 in only 3 days. One way to avoid the disruption in one market is to be invested in another. But can we learn to anticipate any others? On your screen is the weekly chart of SPPP, or the Sprott Physical Platinum and Palladium Trust. One interesting note about Palladium is in 2022, Russia was the leading exporting country of the rare metal worldwide, accounting for 18.1% of total exports based on value. With the price of the trust down to 10, the downside seems limited. There's a recent 52-week low of 855, not investment advice or advisor, but no one can argue that the headlines coming out of Ukraine are only getting worse for Russia lately. We could see a disruption in the palladium supply coming out of Russia. What's more is the trust has appeared on the New York Stock Exchange list of threshold securities since last Wednesday. 13 consecutive settlement days is rapidly approaching, which should be coming this Friday, June 7th. With regards to platinum, the world platinum market posted a deficit of 878,000 ounces for 2023, according to a quarterly report from the World Platinum Investment Council, or WPIC. That was the deepest deficit based on WPIC data going back to 2013. Global platinum supply will fall short of demand for a second straight year in 2024, with the WPIC forecasting a near record deficit for 2024 because of weak growth in supplies and a climb in first quarter automotive demand to the highest in 7 years. Uncle Frank is building a position in SPPP at these levels. This is not investment advice, nor am I an investment advisor. Look, I'm not rooting for war. I'm rooting for peace talks, but it's impossible to ignore how dangerous this conflict is becoming, and I'm deeply concerned about any escalation from here, especially by Russia. If this isn't a black swan feather, I don't know what is. Russia suffers highest monthly losses since war began. Russia loses 1,390 soldiers and over 200 units of equipment over the past day. Ukraine says 9 Russian jets downed in a month. U.S. concerned about Ukrainian strikes on early warning radar on Russian soil. Nearly 24 Russian naval vessels have been damaged or destroyed by Ukraine since the start of Russia's full-scale invasion in 2022. But only 10 hours ago, Going back to my Palladium trade, strategic blows to Russian logistics. Ukraine strikes key supply lines into occupied Crimea. And from Sunday morning, China ready to forcefully stop Taiwan independence, according to their defense minister. From the FDIC, number of problem banks increased in Q1. And then from Wolf Street, status of banks' unrealized losses in Q1 worsened after brief rate cut mania relief. In Q1 2024, unrealized losses on securities held by commercial banks increased by $39 billion or by 8.1% from Q4 to a cumulative loss of $517 billion. These unrealized losses amount to 9.4% of the $5.47 trillion in securities held by those banks, according to today's FDIC quarterly bank data for Q1. And will the commercial real estate market crash? The CRE market is currently facing a looming crisis that experts predict could surpass the challenges experienced during the 2008 financial downturn. Analysts at Morgan Stanley have raised concerns about the industry, citing recent loan defaults by prominent office landlords and a decline in demand for office spaces as warning signs. Gary Gensler and the SEC lose in court again. A judge has dismissed the SEC's fraud case against crypto brokers based in Utah and ordered the agency to pay their attorney's fees, which hands the $1.8 million tab to the taxpayers. In March, the judge formally sanctioned SEC attorneys in the case for presenting misleading evidence during their bid to freeze the assets of DebtBox. Now that's what a real CEO looks like. From yesterday, Ripple CEO considering IPO outside of the United States. Ripple CEO says Biden must get rid of SEC Chair Gensler if he's serious about crypto. Ripple is exploring IPO options abroad amidst SEC challenges for financial privacy. Garlinghouse doubts U.S. IPO feasibility due to SEC leadership under Gensler. Garlinghouse predicts $5 trillion market cap valuation, foresees XRP ETF coming soon. Okay, we've got a lot of stuff to put on the calendar, so let's get it over with. From Wall Street Breakfast, Wall Street will be zeroed in on the May jobs report this week, which hits Friday. The update on non-farm payrolls will be the last one before the Fed Reserve meets on June 11th and 12th amid growing uncertainty on the timing of rate cuts. The April PCE inflation report released Friday showed the Fed's official target. The 12-month core PCE came in at 2.8%, steady from March's reading. Things are a little bit different across the Atlantic, where the European Central Bank is expected to cut on June 6th. The earnings schedule for this week includes reports from Hewlett-Packard, Lululemon, and NEO. Investors will also be watching Nvidia, just ahead of the 10-for-1 stock split that becomes effective after the close on Friday. Okay, so how do the next 2 weeks look for the hedgies? I told you they played their hand already. Now they've got to navigate their way out. Monday, June 3rd, 9:45 a.m. Eastern Time, S&P Flash Manufacturing PMI. Wednesday, June 5th, 8:15 a.m., ADP employment figures. 9:45, S&P Flash Services PMI. And then at 4:15, we've got a CAT event, an industry testing checkpoint Zoom call. And by the way, you can participate if you want to. Thursday, June 6th, 8:30, initial jobless claims. We're also going to get the European Central Bank rate decision, and the Nvidia split process begins. So what's going to happen? The split will affect shareholders of Nvidia common stock as of market close on Thursday, June 6th, with investors receiving 9 additional shares after market close on Friday, June 7th. Speaking of Friday, June 7th, that's the big day. U.S. employment and unemployment rate. Bad Boys, Ride or Die will be released at AMC. Of course, we'll have AMC and GME options expiration. Tuesday, June 11th, the FOMC meeting begins, right, and carries on to June 12th. According to NASDAQ, on June 11th, GME is expected to report earnings on June 11th after the market close. This report will be for the fiscal quarter ending April of 2024. Wednesday, June 12th. If that wasn't all enough, 8:30 in the morning, CPI, Consumer Price Index. At 2 p.m., minutes of the Fed's May FOMC meeting will be released. Then Thursday, June 13th, 8:30 in the morning, PPI, Producer Price Index. We've got a full calendar for the next 2 weeks. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.